Hello friends, I am Ashwini Gavhane and today we are going to see the weighted average cost of capital. The weighted average cost of capital is a financial ratio that calculates the company's cost of financing and acquiring asset by comparing the debt and equity structure of businesses. In other words, it measures the weight of debt and the true cost of borrowing money or raising funds through equity to finance new capital purchases or expansion based on the company's current level of debt and equity structure. Management typically uses the ratio to decide whether the company should use debt or equity to finance new purchases. This ratio is very comprehensive because it averages all the sources of capital, including long term debt, common stock, preferred stock, and bonds. To measure an average cost of borrowing funds, it also extremely complex. Figuring out the cost of debt is pretty simple. Bonds and long-term debts are issued with stated interest rates that can be used to compute their overall cost. Equity, like common and preferred shares, on the other hand, does not have readily available stated price it. Instead, we must compute an equity price before we apply it to the equation. That's why many investors and creditors tend not to focus on this measurement as the only capital price indicator. Estimating the cost of equity is based on several different assumptions that can vary between investors. Now let's take a look how to calculate a weighted average cost of capital. Here is what the equation looks like. The WACC formula is calculated by dividing the market value of the firm's equity by the total market value of company's equity and the debt multiplied by the cost of equity multiplied by the market value of company's debt by the total market value of company's equity and debt multiplied by the cost of debt times 1 minus the corporate income tax rate. Now let's break the WACC equation down into its element and explain it in simpler terms. The WACC calculation is pretty complex because there are so many different pieces involved. But there are really only two elements that are confusing. Establishing the cost of equity and the cost of debt. After you have these two numbers figured out, calculating WACC is breeze. What is cost of equity? Cost of equity represented by RE in the equation. It is hard to measure precisely because issuing stock is free to company. A company doesn't pay interest on outstanding shares. In addition, each share of stock doesn't have a specified value of or price. It simply issues them to investor or whether investors are willing to pay for them at any given time. When the market is high, stock prices are high. When the market is low, stock prices are low. There is no real stable number to use. So how to measure the cost of equity? We need to look at how investors buy stocks. They purchase stock with the expectation of return on their investment based on the level of risk. This expectation establishes the required rate of return that the company must pay its investor, or the investors will mostly likely sell their shares and invest in another company. If too many investors sell their shares, the stock price could fall and decrease the value of the company. I told you this was somewhat confusing. Think of it this way: the cost of equity is the amount of money the company must spend to meet investor required rate of return to keep the stock price steady. Now let's see cost of debt. Compared with the cost of equity, the cost of debt represented by the RD in the equation is fairly simple to calculate. We simply use the market interest rate or the actual interest rate that the company is currently paying on its obligation. Keep in mind that interest expenses have additional tax implications. Interest is typically deductible, so we also take into account the amount of tax saving and the company will able to take advantage of by making its interest payments represented in our equation RD 1 minus T. So what does all this mean? What is WACC used for? To put it simply, weighted average cost of capital formula help management evaluate whether the company should finance the purchase of new asset with debt or equity by comparing the cost of both options. Financing new purchases with the debt or equity can make a big impact on the profitability of a company and the overall stock price. Management must use the equation to balance the stock prices, investors' returns expectation, and the total cost of purchasing the asset. Executive and the board of directors use the weighted average to judge whether the merger is appropriate or not. Investor and creditors, on the other hand, use the WACC to evaluate whether the company is worth investing in or loaning money to. Since WACC is represent the average cost of borrowing money across all financing structures, higher weighted average percentage mean the company's overall cost of financing is greater and the company will have less free cash to distribute to its shareholders or pay off additional debt. As the weighted average cost of capital increases, the company is less likely to create value and the investors and creditors tend to look for other opportunities. Thank you.